Hi everyone, and thanks for joining the course. For today, that will be the last module. Hopefully we will fit into 1 hour. So far we are almost on a schedule, only a couple minutes off. And today we are diving into cost of sales. Cost of sales is a bit complicated topic. That's because there is no straightforward guidance for the cost of sales like there is for revenue. Basically, what they tell you in the GAAP guidance regarding the cost of sales and why there is no cost of sales guide, they tell you that with GAAP guidance you can measure your assets, you can measure your liabilities, you can measure your revenues and incomes, and your cost of sales will be whatever will balance everything. As you know, your balance should balance, accounting equation should work, and assuming the accounting equation, you are to figure out your cost of sales like on your own based on how you figure out everything else. And I will give you an example here. Let's see. I was even working on some examples here yesterday. So that should be inventory and cost of sales cycle. So that is a bit complicated example. But I will try to show you what I'm trying to explain. So let's take this example. We have no opening inventory. Then during the period we purchased 100 items of inventory and spent on that 2,000 cash. Then we sold 30 items of inventory and we removed from the inventory $600 and 30 items. So at the end, it's easy to calculate what we have at the end. 70 items at $20, $1,400. Everything seems straightforward so far. But now we purchased additional items, 20 items at $15 per item. So the price is different. And then we sold another 50 items in the period. And the question is, what price shall we use to write this off? What price shall we use to write this off? And what price shall we use to value our inventory at the end of the period? What would be the correct assumptions here? And in that method, it's first in, first out method. Let me add it here. In first in, first out method, we assume that we first sell the items of inventory which we first bought. So because we only sold 80 items, they fit in our first 100 items. So we assume that we sold this 50 at 20 and we have $700 left in the costs of inventories. Oops, sorry. And we have 40 items left in the inventories. And this way we figure out that our ending inventory cost is 17.5. Okay. So now we sell 30 items of inventories. And that's where it gets even more complicated. We need to figure out what value of inventory did we sell. So here we can see that it was basically we sold 80 of a $20 items. It's all the same inventory. It's not different inventory items. It's all the same inventory. Is there any issue? I don't see much people connected to the stream. Do you have any issues with the stream? Okay. So let's continue. So we see we sold 80. So we have 20 left over $20 items. And we need, because we use first in, first out assumption, we need to use 10 of $15 items. And I basically calculated here 20 by 20 and 10 by 15. I got 550 and I figure out the average cost of what I used in the cost of sales, what I sold. And basically whatever is left is kind of what is left. Alternatively, we can figure out that we got only 10 items left in the inventory. So these should be the items which were most recently purchased. And our most recent purchase is here at 15. So we can figure out that number and then calculate that number. And that's how I explain that your cost of sales, it will be the way you value your ending inventory. So you have opening inventory and you have a standard accounting standard for inventory. You have closing inventory and you have accounting standard for inventory. You have some purchases during the period which you recorded again according to the inventory standard. And then your cost of sales will be whatever amount will balance all of that. So that's what they meant when they say that to calculate cost of sales, you need to apply other accounting standards. For example, the one on the inventory. In addition to first in, first out method, there is last in, first out method. And that's basically the opposite method. And as you can see in the closing inventory here, I was left with 10 inventory items at $20 because that was my earliest purchase of inventory. And there is also a weighted average method which kind of tries to average your inventory costs every period. And it's a bit complicated calculation for spreadsheets, but there are specific systems which are already designed to calculate that. So weighted average method kind of average everything down. So let's go take a look at our MIT lectures. I gave you that example only to make some introduction to MIT lectures. That's available in the schedule right here, and I will share the link with you. Let me just ask a few questions in the chat. It looks like it's either the connection issues or everyone just has a break and I don't have much viewers. It's kind of psychologically hard to try to explain something when no one is listening and there are no viewers on the channel. But anyway, I know you will watch that in the recording. So it's just a bit of my motivation. Okay, so we have it here. Let me see if I can open it in editor to to make some drawings. Okay, I can do that. I will adjust. Let me know if anything is blurry or if I need to zoom in. Okay, inventory. Inventory is defined as goods held for sale in the normal course of business or items used in the manufacture of products that will be sold in a normal cost of business. Okay, and let's see PWC inventory. So as you might remember, that lecture is like 15-year-old, and that's why I will have an inventory guidance here to consult with, and that will be PWC Inventory Guidance. Let's see if I have a link here. I will be providing links in the chat. If any one of you is too lazy to Google, it's in the chat. Just click it. Okay. So here is the guidance. I will probably need to zoom in a bit. Okay. Okay, inventory. So how does accounting standard defines inventory? The aggregate of those items of tangible personal property. So it's tangible personal property that have any of the following characteristics: held for sale in the ordinary course of business. Okay, let's try this one and bigger. In the process of production for such sale. To be currently consumed in the production of goods or services to be available for sale. So it's basically a piece of tangible property which you are either going to sold, but you should distinguish that from your property, plant and equipment, or you are going to use that piece in the production process to produce something you are going to sold. Or you're going to use that piece in rendering of the services that you render to a customer. So that's what inventory is. I believe intuitively you should understand that. If you're a manufacturer, your raw materials are your inventory. If you're a manufacturer, you have work in progress, you have some unfinished production which you are going to turn into finished goods and then sell. For example, if you are a car manufacturer, you will have some cars which are partially assembled, and that would be a work in progress. You might also have some spare parts and some ancillary materials which you also use in the production process, but maybe not very directly in your inventory. For example, if you have some manufacturing, like a plant, and you have some equipment there, manufacturing equipment, and that equipment which you use in the production, that will be your fixed assets. However, if you keep a supply of spare parts or replacement parts for that equipment, that would be your inventories. That would be your inventories. Okay, no one says if anything wrong with the translation. Let me see if I can do, 720 seems readable to me. Okay, so basically that's what inventory is. There are some complications with inventory too. So you need to determine which costs or portion of costs should be capitalized as inventory value. So that's one problem. Which cost, at what value should you value your inventory? and that will be in the standard. A second problem, when you need to start to recognize your inventory on your balance sheet, and that's primarily that happens when you get a title to inventory. But in some circumstances, you might not get a title to inventory. Someone else might still own that inventory. But you will have other circumstances which will say that you need to recognize that inventory. And that can happen in the consignment situation, in the consignment arrangements. Okay. And here in the standard, they have a list of issues which you need to evaluate if you have a consignment arrangement. Like, for example, if the inventory is stolen or destroyed, who will be responsible? Who bears the market risk as it relates to price fluctuation, volatility of the inventory? So if you store some commodity and price fluctuates, some oil, and if you possess, if technically that oil is owned by another person, but you will have to reimburse that person for the price fluctuations, that means that you kind of have exposure to that oil, and probably you need to recognize it as your own inventory. Does the company have fixed or determinable obligation to pay for such product? For example, again, if you get some product in your warehouse, but title hasn't passed yet, but you know that it will happen soon and you kind of sell these products anyways, so that might indicate that you have to recognize that inventory. Most of the time it's just straightforward. You just sell what you own, and when you buy inventory, you buy the title passes at the moment when your carrier gets it or when it is delivered to your warehouse. So let's assume more or less popular business nowadays, like drop shipping, when you order some products in China and they produce these products and they load them on a ship, they are delivered to American port, and then they get into Amazon warehouse, and then they are sold. So the question is, when do you recognize the value of your inventory? And the answer is whenever title and risks are passed to you. For example, if you buy these products under delivery duty paid terms, like if you don't care about what happens to the products up to the point when they are delivered to your warehouse, like if you don't owe money to the supplier if something happens to the products on the ship, then you need to recognize the ship, then you get your title and your products when they are delivered to your warehouse. Let's take like an opposite view. For example, if you buy the products on the free on board terms, like the title passes from supplier to you when goods and products are loaded on the ship, then you most likely recognize that inventory on your balance sheet when they are on the ship. And now the second questions. Let's open. Let's call it costing. Let's do one small exercise here. Chinese for what is most popular Chinese stuff on the internet. Let's say just mattress. Let's start. Price at length. Let it be $100. That will be Incoterms. So that basis is called xworks. Let's call it now shipping to port. So shipping to port and loading, $20. Price at port, at ship, let's call it on ship. This will be FOB, and that will be 120. So when depending on our contract, the value at which we initially recognize inventory will depend on at what point we buy it. Let's say freight, sea freight. That will be sea freight, $20. Price at US port, and let's call it delivery duty unpaid. So price at the US port will be sea freight, let's say it's plus unloading. Let's add duties here, and let's also add freight tracking to warehouse. Let's say we pay $10 in duties and $20 in traffic, and it's cost at warehouse. And that would usually be delivery duty paid. Okay, so we based on our contract, we can own the inventory like at any of these points. Now is the question, will it impact the final value of inventory on your balance sheet, depending on your contract terms, depending on where you buy it, if eventually the inventory will end up in your warehouse? And the answer is because accounting standards want everything to be consistent across different balance sheets of different companies. Your value of inventory will be the same when you get it in your warehouse. It will be the same regardless of your contracts. It can be recognized in different periods, but eventually you will get $170 cost. Let's call it cost to be clear. So that's how your cost of inventory is formed. Again, it's the inventory for resale that will follow that pattern. Okay, that was a real life example. Let's get back to some MIT. Okay, let's see if I can make it nicer here. Yeah, I can. So we define the inventory. Inventory is recorded on the balance sheet at the lower of the costs or the market value of inventory. Okay, so we have lower of the costs and market value of the inventory. In a new standard, they updated it to where is it? Okay, here. They updated it to net realizable value. Okay. Inventory costing. The primary basis of accounting for inventories is cost. Provided, okay. How do I get it? Okay. Provided cost is not higher than the net amount realizable from the subsequent sale of inventories. Let's get here. Okay. So we know that it's no longer market, it's net realizable value. These are pretty close concepts. And as you can see, there is a ceiling for your inventory value. I don't know what does it show, but if your cost of inventory is growing, like if it goes here, but your market, your net realizable value, it's on RV. That's basically the value for which you can sell a product at a fair transaction, less the costs to perform such sale. If your net realizable value is like fixed here, then you shouldn't put your product on your inventories at a value above that level. It shouldn't exceed it. Let's get back to mattress example. NRV 1. So let's assume net realizable value is $200. Our standards say it should be lower cost versus NRV. And the lower is, let's use a formula as a smart guys and ladies. Minimum here. NRV months 2. 150. And again, $150. And now we need to write off the inventory. We need to write off the inventory for $20. And that would be, most likely you will credit inventory provision and debit cost of sales for that amount. In some companies, I've seen that they reflected inventory provision separately as a separate line item. Probably for some very inventory reliant businesses. Okay, let's see what else do we have here. Okay, definition of inventory. The cost of inventory includes all costs necessary to bring the inventory to a saleable condition. That's what we just did here. Our saleable condition of that mattress is $170. Let's assume, what if we do some work with that mattress after we get it? Let's say we have it cost at our plant. And now, extra work done on mattress. And that would be $20. Okay. And let's finished goods cost. So our finished goods cost will be 190 NRV. Let me just adjust that. Okay, so if we do some job with the inventories to bring it to saleable condition, that all should be capitalized in the finished goods cost. And here we have kind of an inventory equation. So we have some beginning inventory and we have some acquisition costs, and we drive all of that into cost of goods available for sale. If we go to our example, that will be for this first one. So here are our purchases, and here are our sales, and we got some closing inventory, and then we have additional purchases, and then we have additional sales, and then we have a closing inventory here. So that's basically for our example. As you see, we accumulated within 1 month, we accumulated beginning inventory and acquired inventory, calculated what we have on hand, and then we allocated that to what we sold and to what we have at the end. And the question is, which costs come out? How do we value what we have in the ending inventory and what we sold? And here is this. We need a cost flow assumption. And that assumption is first in, first out, last in, first out, or weighted average. And it's basically described in the same way in the accounting standard. So I will switch between accounting standard and presentation, just to show you that it is all about the same. And even if we look into taxes, let's see where it is, 538 inventories, we will find about the same concepts. I need to warn you, there are differences from time to time between taxes, especially in last in, first out model. But in taxes, it will be generally the same. For tax purposes, you will need capitalized inventory. To figure out your taxable income, you must value your inventory at the beginning and end of tax year. To determine the value, you need a method for identifying the items. And where is it? Identifying cost. Specific identification method. So IRS offers you, if you know for what price you bought what exact inventory piece and its price, you can use that. Or they also offer you FIFO method and LIFO method. So basically, it is more or less in line with other guidance. Okay, let's move on. It is important to note here that the abnormal costs, if you have any wasted materials, spoilage, or any abnormal freight or handling, which is not the normal course of the business, it should be included in the current period expenses, not capitalized on inventory. So any spoilage, you just write off the spoilage when you identified it. Or if you kind of, let's say you buy 100 mattresses from China and you need to discard one mattress, usually, you just allocate your cost to 99 mattresses and you write off one mattress. If you kind of figure out that you need to write off more than one mattress, let's say 20 mattresses, you need to write off all the costs related to these mattresses. You do not allocate your costs to, you do not capitalize your costs to 80 mattresses. You need to write off your extra spoilage. Lower of cost, okay, we already covered that. Lower of cost and NRV, that's how we keep inventories on our balance sheet. We have a definition of NRV, the estimated selling price. So it's estimated selling price in the ordinary course of business, a less reasonably predictable cost of completion, disposal, and transportation. Additionally, no loss should be recognized on inventories unless it is clear that a loss has been sustained. And that usually means that the fluctuation in the inventory price because of which you recognize your loss, it should be kind of sustainable. It shouldn't be like one-off. If you have some inventory on December 31st and in the first week of January all prices dived, but they recovered afterwards, then you probably won't need to recognize an adjustment here, NRV adjustment. A complication is that you need to apply NRV to work in progress and raw materials. Even before you created a finished product, you need to make an adjustments to raw materials. If you know that you will create a loss-making finished product from your raw materials and work in progress, you need to make respective adjustments unless you can prove that you can sell those raw materials or work in progress as separately for higher than you are selling your finished goods based in these market conditions. Okay, so as always, NRV will require application of professional judgment and all available data. Subsequent events. As part of your net realizable value, how do you determine that your inventory will be loss-making at the year end? It's either when you're already selling it at a loss, or if subsequent to the year end your prices declined significantly and didn't recover within a reasonable amount of time. So you basically test like for which you actually sold your inventory post year end, and you might want to recognize the retrospective adjustment. That's basically what the standard says. I'll give you an example. You might say that, okay, we already closed the year. How do we make an adjustment? And that will be somehow top level adjustments. You just do it on the top to reflect it in your financial statements. And in our example, I work for a coal company and we sell coal on the ships. We export metallurgical coal. And it is hard. Coal is a commodity and it is hard to predict price fluctuations post year end. And we close our books in the first week after the year end. And we did some assumptions for related to that coal, that we will sell that coal at a certain price, and we recorded our estimates for the inventory impairment. We impaired the coal to the net realizable value. However, we have like a stockpile of a few months of sales of that coal. We had a lot of coal, and we've been selling that coal for January, February, and even March. And prices declined so much during that period that we actually had to recognize a retrospective adjustment to these inventories in our financial statements. And that was possible because we issued financial statements like in May or June. We are a private company, and we do not have a requirement to issue financials on a on some schedule. We can issue financials later than like 30 or 45 days or 60 days after year end. So we incorporated that adjustment into our financial statements. Had we issued our financials earlier, like in January, we would probably have a different inventory value for coal at December 31st previous year than if we issued financials in May. So that's what subsequent events can do for your inventory valuation. Okay, finally, I'm seeing some people on a stream. I remind you that if you are a bit late to a stream, and if you can do that, you can try to catch up by increasing the speed, increasing the playback settings in the stream. Like you can do that here. Playback speed, you can do 2x, and that will help you to catch up. Okay. Adverse purchase commitments. That's what you also need to keep in mind, that if you are committed to some inventory, to some fixed price purchases, you might be able to impair inventory unless you have other means to recover that. Declines. So if you report interim financial statements, you might want to recognize NRV on interim too. Mark-to-market inventories. These are a very limited set of inventories like precious metals, which you can value based on market value, not at cost. However, you have to have no substantial you must justify it by inability to determine approximate costs, and such circumstances are extremely rare when you can do that. Okay, let's switch back to our okay, we stopped at cost flow assumption here. Let's move to full absorption costing. Let me see if okay. Let's move on the presentation, and then we will go back to the standard. So here it is. We have beginning inventory, we have purchases, we have production. So that's debit. Our inventory increased by purchases and by production. And our inventory decreased by cost of goods sold. And at the end we have ending inventory. Okay, what costs go into the value of the inventory? So inventory costs should include all costs necessary to bring the inventory to a saleable condition. We already saw that in the standard. All costs to acquire, manufacture, prepare. Shipping costs for retailers. And I assume that means shipping costs to the place where you sell stuff. Overhead costs and direct labor and materials for manufacturers. That topic, inventory costing topic, is a quite complicated topic, and I believe in universities there will be a separate subject on cost accounting, because there is like a billion ways you can allocate costs to the inventories. It is standard costing or actual or variances. You might want to read up on that additionally. And that's how they draw you costs in the T accounts. So basically whatever you buy, or maybe you can buy labor too, like salaries, you can buy materials. So that's payables or cash, that's credit, debit. So you buy, first of all, you buy something. You buy materials, you buy labor, you buy some overhead. You spend money on overhead eventually, like utilities. Then you allocate that to work in progress. That's debit, work in progress, credit, whatever we have here. And then that when work in progress is done, you allocate the costs to finished goods. Let's try to run an example in let's do that in the costing. Let's say we get 100 matrices at let's remove that. Okay, let's keep it extra work done on matrices. Let's call it handling. So we received let's call it inventory. Okay, 100 here. 190 is the price. The amount is here. Okay. When we have finally received those matrices, let's say we bought them let's say, okay, for our example, let's get it from here. So we received it at our plant. We paid the manufacturer. So we would credit cash and we recognize that inventory. So 17,000 paid, 17,000 recognized. Then we paid for the handling, assuming that was done by some contractor. That would be credit cash. We pay for everything with credit cash. And that would be 100 items. So same 100 items, but handling per item was $20. Let's assume we are not, we initially recognize that as an expense in the period. So that would be this amount, credit cash, debit handling costs. Now we figure out that we need to capitalize that cost to inventory, to months end inventory. So first way to do it, way one to do it, we credit handling and debit inventory value. Okay. We could have recognized it in the inventory from the beginning here. And we debit inventory. Way two. We still debit inventory. That's we have to do that based on accounting standard. But instead of crediting handling, we will recognize special accounts change in inventory. And that would be the same amount. And we do that depending on what way we want to see our cost of sales statement. Let's say we have a cost of sales statement where we have revenue, inventory, inventory sold, change in inventory, handling. So for revenues, we have 0 so far, and let's call it way 1 and way 2. So far we have zeros, zeros. In this one, in the way 1, we will have no change in inventory and no handling expense. So everything sits in inventory. We didn't perform sales, and our net cost of sales is 0. For way 2, we will have kind of a gain from changing inventory credit, and we also have a cost for handling expense here. This way, in an extreme situation when we don't have sales, so as you see, net cost of sales is also 0, but at least we will be able to see how much did we spend on handling or other, like let's say paid for handling. Let's also say paid for labor. Let's say $5, 100. We do not pay our workers much. We paid $5 per mattress. Okay, paid for labor. And that will be credit cash, debit labor expense. So if we add labor here in this presentation, we will show labor expense, debit inventory. Let me add it here one by one. Credit labor 500, 2500. Okay. Change in inventory. Okay, I need to change a sign here. Okay, now it works. Okay, paid for labor. Paid for packaging. Paid for packaging. In theory, packaging will be inventory 2. So if we paid for packaging, we credit, cash, debit, packaging. Let's say we do that with 100. So we will not probably have packaging expense. Okay, so that is the way it is done. So in first situation you have zeros because you allocated everything. Let's also pay for utilities like overheads. Okay, 300. So here we will have credit utilities. Credit you can probably account for some packaging separately, but we will account for it. Okay, packaging. Sorry. Utilities. So here we have utilities. We credited everything and we debited inventory. Okay, 2900. Utilities. Debit packaging, and that's an asset account. Utilities 300. Change in inventory. Okay, that should be without a minus. Okay, I hope you get a gist of it. So if we didn't sell the inventory, our net cost of sales should be 0. What did I miss here? I missed packaging, and I missed it because it's already been capitalized. So I shouldn't include it into that change in inventory. It wasn't an inventory change. So I need to reduce my packaging here. Now let's assume that we sold debit revenue. What numbers do we have here? We also have these matrices, 170, let's say to 50. Let's say we sold 50 matrices at 250 and we generated that amount of revenue. That should be credit revenue, of course. Debit cash credit revenue negative, debit cash positive. Okay, now we need to reflect our cost of sales. So that was, let's say it is period 2. And here we have period 1. And now we have period 2. Let's think for a moment. In the first way, we just added everything to the value of inventory. Let's probably not overcomplicate stuff. Let's assume that we sold everything. That will be a bit easier to do. And then, of course, we can move on. Let's also add revenue here. Okay, so revenue will be the same under every method. Now, for inventory sold, under the first way, we just stuffed everything under inventory sold. So we go take that amount, 2,900, and we also add an initial investment here. Initial investment into inventory. We can actually multiply it by that amount and divide it by that amount, just in order to, if you want to allocate amounts, we can do that. Now, for the first method, we will have we didn't capitalize anything to initial inventory sold. Instead, we used we capitalized to initial inventory sold, but a bit different amount, 2,800. So under that, we will reflect that amount in here, 2,800 plus 17,000. Then we also used change in inventory account, and we need to reverse that. Let me think for a moment. I'm trying to figure out. So we capitalize that to inventory. So we credited inventory. We credit inventory for total, for that total, and we debit cost of sales. So we kind of reverse that number, but in the inventory we do not take it into account. 49. Okay, and we also used packaging inventory. Let's just say packaging. And we use 100 of that. When we actually sold, we recognize the cost of sale based on matching principle and accrual basics. We recognize that packaging costs. Let me just write here. Let me call it cost of packaging used in sales. So we did not use any packaging in sales here, and we used some here. And now let's do 1 plus 2. I need to do a bit of formatting here. Okay. So you see, we got with this both methods, we got same net profit. However, the method 2 provides us with an interesting breakdown of cost components. And with these cost components, the accounting standards require us to have our data comparable, and that's why if you cannot put that into your financial statements, you will have to figure out based on various techniques what your actual costs were by components. If you provide such data in the financial statements. If you do not, then you can skip it. But this method is more, I like it more because it provides, like, I know what was my handling, what was my labor, what were my utilities, what was my packaging, and I want to keep these as expenses in the period and adjust my inventory here, like I did here. Adjust my inventory, and that will be kind of an income item. Okay, we are running out of time. Let's take a look what interesting do we have in the MIT lecture. Okay, so that's the movement of inventories. That's all of that. That's our debits and credits. We already buying of inputs. We already covered that. Everything going into work in progress. We we reflected on such an example. Finished goods reclass from work in progress to finished goods. That's what we covered. Finished goods, works of goods sold. Yes. Debit cost of sales, credit finished goods. We discussed when we have that situation. How do we know how much has been sold? So we either keep a perpetual systems, so we track units. If we can, most of the time we cannot do that, but in theory we can, or we run through periods, and we calculate quantities sold by using purchases, production, beginning and ending inventories. So we kind of calculate what we have at hand, and then retrospectively look how much we did sold. So beginning plus production minus ending, and we got what we sold. Or we just count what we sold here. But in that case, we have a problem with shrinkage, theft, spoilage, management fraud. So that's not a perfect system too. Okay. Now, as we already covered, LIFO and FIFO. LIFO is last in, first out. FIFO is first in, first out. And we can use both of these under US GAAP for inventory. However, if I remember that correctly, if we use LIFO, we need to provide reconciliation to FIFO anyway. That's because most of the entities use FIFO system, and your financial statements needs to be comparable. And for comparative purposes, if you use LIFO, you reconcile it with FIFO anyways in your financial statements. First in, first out, last in, last out, beginning purchases. The accountant must separate goods available for sale into ending inventories and cost of goods sold. This separation is done based on the physical flow assumption. FIFO. So the earlier, so that's what we have at the beginning inventory, that was we purchased, and when we sold something, we sold beginning inventory first, and then only we start to sell current purchases starting from the earliest purchase. In LIFO, okay, FIFO. Okay, here it is, LIFO. In LIFO, we start from the purchases. When we sell, we start with the most recent purchases first. And our ending inventory, it kind of sits idle. But again, that's only for accounting purposes. You do not monitor movement of actual items. So, for example, if you have some groceries, you might be selling, in reality, you might be selling what you purchased earlier. But in your books, you reflect it as if you are selling the ones which you've just purchased. So if we do LIFO in real life, in groceries, for example, we will always get our beginning inventory spoil, and that will be very unwise business decision. But we only use that LIFO for accounting purposes. We assume that we allocate to cost of sales like what we purchased last compared to what we purchased first in the FIFO. Here we have one more example. I will not stop on that today. I want to near the conclusion of the lecture. So here they basically show you what I've shown you in the example here in the inventory worksheet. Here I have LIFO example. So in LIFO, our closing inventories will be valued at the value which approximate our earliest purchased inventory. So you see we purchased first inventories at 20 and our closing inventory is valued at 20. In FIFO it will be the opposite. Our closing inventory will approximate in value our most recent purchase of inventory. Here we buy it for 15 and our closing inventory is valued at 15. Okay, where is our lecture? Income statement and balance sheet. Here they provide the same exercise as we did in the spreadsheet. LIFO, FIFO. So as you see, in LIFO, assuming the inventory increases in costs, historically, which happens historically due to inflation, in LIFO, our cost of goods sold will be higher compared to FIFO. That's due to inflation. If our inventories go down in value, our FIFO cost of sales might be higher than our LIFO cost of sales. Recent costs are on the income statement. Matches current costs with current revenues. Old costs are on the balance sheets. It's for LIFO. Assuming increase in inventory stock, LIFO results in a tax savings. I don't know what is political visibility. Honestly, I don't know what is political visibility. LIFO versus FIFO example. Okay, mixture. So that here they provide the same example which we have already considered. Mixture. This is where they try to calculate the taxes based on LIFO and FIFO. Let's take a look here. What is cost of sales? So cost of sales will be whatever we have here with the minus. Okay, sold during period. 2160. LIFO 2150, 2100, and weighted average 2111. And that's highest due to inventory decreasing. So we did a bit of opposite example. Here we have we didn't have inflation. We had like a deflation of the inventory. So that's why our FIFO method showed us the highest cost of sales. But in general, if you use, everything is subject to inflation, and inflation is a hot topic now. So generally, we can save on taxes by using LIFO method. LIFO inventory incentives, 500 pre-tax. Company seems to lose money by purchasing inventory. If we do not liquidate any of the old inventory layers, we will have 199 less income. Thus we had 199 of income resulted from liquidation. eventually at the end, when you liquidate your inventory, you will have very low cost of sales, and that might result in additional tax liabilities. So you will need to monitor that. If you use LIFO, your cost of sales might be pretty low at some point when you liquidate stuff. So you might be interested in keeping purchasing the inventories to keep your costs high for the tax purposes. LIFO liquidation process. Okay, here they provide you, if you are interested in that, you can read up on that. They provide you various situations when LIFO will generate you extra. In some period, it can generate you extra tax liability. So you need to be pretty accurate with LIFO method. Conversion from LIFO to FIFO, the LIFO reserve. The LIFO reserve is the difference between inventory value under FIFO and the value under LIFO. Companies using LIFO must disclose the reserve. That's what I was talking about. So when you actually run LIFO in your company, you kind of also have to do FIFO in your company. And that's basically doubling your work, unless you have a pretty good system established to run that. And here they have a calculation of the conversion calculation. I would say it's more of an advanced accounting. We need to know that such things exists. And we need to know what are possible tax implications, that LIFO can potentially help you to save on taxes. And I think I will do that for today's homework. We will consider inventories for tax purposes. We continue to work on our tax memo, which we did on homework 2, and we will look into taxation related to inventories. I want to remind you that next couple of weeks will be kind of holidays, and we will not have lectures, and everything will be kind of remote or uploaded. If I do some video, I will upload it and share with you, but we will not have streams because of the holidays and travel schedules. And at the end, they provided us some examples from financial statements. Let's actually see what Apple has to say about its inventories. We need to find annual filings. PDF. Let's see. Risk factors, financial statements. Okay, let's find. Inventor. Do they even say something about inventory? They say that the company has a risk. So probably Apple just skips on inventories because they are pretty small in their financials. Just $6 billion. No one will care. Oh, yeah, we have it. We have one line in Apple financials for inventories. Inventories are measured using first in, first out method. So let's take a look here. Kmart. It probably still exists. I'm not sure. Or Kohl's. Probably Kmart bankrupted. Last in, first out method. Utilizing internal inflation indices. Inventories valued on LIFO were lower than amounts that would have been reported under the FIFO method. Okay, 1996, the company liquidated certain LIFO inventories that were carried at lower costs prevailing in prior years. The effect was to increase earnings before income taxes by $692. So when you run LIFO, you have some profit reserve because of the low value inventory. If you want to bump your profit, you will liquidate your LIFO reserve. On the other hand, it will impact your tax liability. So you need to think twice if you want to do that. Okay, and here they calculate tax implications of that. So I think we are concluding here. I will prepare homework tasks today, and I will present the homework task for today for the next 2 weeks in the evening session today. Thank you everyone for coming. Hopefully we will have some questions on the Q&A today. If not, that's okay. You can always message me or on Telegram or Messenger. Thank you and have a great weekend. Bye bye.